Welcome to Managerial Accounting. It's the fall 2022 semester. Today is Tuesday, November 15th, and I believe it's day 24 for the semester. So as you can see, looking at our course schedule in Brightspace, because we finished chapter 25 last class, the chapter 25 problem should be submitted by the end of the day today for grading. And this week, we're going to be covering chapter 26. So the chapter 26 pre-quiz should be submitted later today as well, if you haven't already done that. Thursday, we'll finish up chapter 26. So the exercises will be due. And this weekend, before you think of yourself as being on break, on vacation for the Thanksgiving recess, please make sure you take exam 3. Officially, it's due on Sunday night. But in practice, you are welcome to take it anytime after you submit the chapter 25 problem. Thank you. So the first thing we're going to talk about today is that exam. And before we do that, just one other note. So I had published an announcement a couple weeks ago with the review session dates for the remaining exams. And I don't know why that's up there. Go away. So, and then go away. Sorry. Don't know what I clicked on. Don't care about you. So, I made a decision yesterday that the review session for the last exam, it's not a final exam, it's just a exam, just an exam like we've had up to that point, that it only covers the chapters that immediately preceded the exam, so 26, 27, 28. So what we're starting today through the end of the semester is what's on that last exam. And the last class day, day number 30, is Tuesday, December, I don't know, it's like the 13th, something like that. And that would be a regular class day for us. Yes, the 13th. Yep. But we will have already completed the final chapter. We will have covered the entire book. So there's no actual class on that day. So it doesn't make sense to have a separate review session when that regular class time is already set aside to be reviewed. And so I removed from Starfish and from our Brightspace calendar the review session that I had announced a few weeks ago would be held either that Monday or Wednesday. And that last class day of Tuesday, December 13th will be for review if you choose to attend. And it will be on Zoom, just like our other review sessions. So at this point, I do not plan to be on campus on Tuesday, December 13th. It's our last day of class, but it's not new material. History has shown that most people do not come to that review session. So if there's a reason that it makes sense for me to be on campus that day, I would be happy to come. But at this point, I do not plan to be here. And so if you want to attend review session on that day, it would be on Zoom, just like all the other review sessions. All right. Questions about that? And then our last test is due at the end of that week. So again, history has shown me that most people are not going to wait until Friday to take that test. You want to get it done and out of the way and be closer to the end of your semester. So the review session, like I said, will be on the 13th at our regular class time. Okay. Questions? Anybody? Everybody's good? Okay. So I said where we were going to start today was talking about the exam that you will be taking at some point this week. I'll put it in the announcement too, of course, but don't forget, you do need to open the ebook before you start the exam. It may block you from opening the book once you've already begun the exam, and that's certainly not the expectation. You are encouraged, expected to use the resources that you have to as you're taking that exam. It just needs to be your own work. As with every exam, there is a practice set. It is not graded, as you can see on the screen. This practice set consists of 11 separate exercises selected from chapters 22 through 25, the chapters that are on the exam this weekend. There is not a video recording of going through these exercises, but most or all of them have the Show Me How button. All of them have unlimited use of the Check My Work button as well. So if you choose to use the practice set as you're preparing for the exam, if you don't get something, if you get stuck on something, I would encourage you to use that Show Me How, use the Check My Work as much as needed. And of course, I would be happy to help with any questions that come up. You just need to send me an email. Tell me, I'm working on the practice set, I'm on exercise 7, and here's my question. And I will be glad to come into Cengage. That's one of the advantages of using this software, is I can come in and see exactly what you're working on and get back to you by email that way. If you're really stuck and want to schedule a Zoom session, again, you can sign up for that in Starfish. You can see me during my on-campus office hours on Thursday, if that would be helpful. But you need to just touch base if you want help with any of this. So 11 exercises, it's not graded, but the exercises were selected with the exam in mind. And so it is a reasonable expectation that if there's an exercise in the practice set, that there also would be a similar exercise on the exam. In case you've forgotten to get to that practice set, you need to click on the button, click on the option for assignments I can practice now, or all assignments. The default in Cengage is to assignments I can take now, but because that's not graded, it doesn't ever show up there. So you'll need to switch to the assignments I can practice now to get to that practice set. So this is the exam, just 24 questions on the exam. And I've pointed this out before, so you know that the numbering of the exercises or the questions gives you direction. If you need to be looking something up, you wanted to check your notes, you can see that these are from chapter 25, 24, 23, and so on. Most of the multiple choice, my expectation is that you are able to just read the question, choose the correct answer, possibly consult your notes or the book if needed. But it's rare that the multiple choice requires you to actually do any work, to do any calculations, for example. The exercises, on the other hand, where you are free response, filling in the number, make sure that you are reading the directions. You know that sometimes I try to skip through the directions and it doesn't ever work out well for me. I would encourage you not to do that either. Make sure you're answering the question that is asked. I wish it were different, but I know when you guys are taking the exam, you can't see how many points each question is worth, right? I didn't realize that was the case, and apparently there's not anything I can do to change that. But I can just assure you that the questions that take more work, the ones that are labeled exercise rather than multiple choice, are worth more points than are the easier, the simpler questions. So take that into account as you're deciding how much time you should be spending on each individual question. They're not all worth the same. Let's see, what else do I need to say? So we've got, again, a mix of questions and problems or exercises similar to what you see in that practice set, similar to the ones that we have done in class or discussed in class. So questions, anything you want to talk about from the review from the chapters that are on the exam this weekend, or anything else you want to talk about before we go into our new material? Okay. So I'm just trying to get there. All right, so I'm going to just go ahead and start with our new material then. And you should have your chapter 26 exercises open and see now. And we'll get to those in a moment. This chapter, new material, not on the exam, but I did talk about this concept last week as we were looking at more short-term decision making. I had given you kind of a heads up or a preview that in this chapter, we're going to be talking about that more long-term decision making or capital investment analysis. So we talk about capital investment analysis, we're talking about buying maybe new equipment, building a new building, expanding our operations, and making some fairly substantial purchases that are expected to benefit the company over some longer period of time. And so this came up last week as we were looking at doing the differential analysis. And I told you that I had some concerns about some of the exercises because they were treating cash flows that were happening in the future, maybe 5 to 8 years later, as if $1 5 to 8 years from now is worth the same as $1 today. And I asked you to just bear with us for that chapter, that we recognize that that is not true, that $1 today and $1 next year are not the same dollar. But I told you that in this chapter, we would, God bless you, we would start to take into account that concept of the time value of money. That if you are given the option of $1 today or $1 tomorrow, you're always going to choose the $1 today. And that's true for businesses as well. So the longer they have to wait for a cash flow, the less value it has for them, for us today, in terms of revenues, in terms of cash inflows. For cash outflows, if I tell you, you have to pay me $1, but you can pay me today or next week, of course, you'd rather wait till next week. And that same thing is true for businesses as well. And so in this chapter, for the first time this semester, we will be taking that into account, that time value of money, and recognizing that future cash flows and present cash flows are not the same. And we'll be seeing how to quantify that, or how to put a value on that time value of money. We're going to be talking, as I said, about capital investment in this chapter. And so we start with the idea of how do companies decide which projects they should even consider. In the last chapter, we spent a few minutes talking about the idea of brainstorming, you know, that we recognize that there's an opportunity or an issue for our company, and we sit down and come up with, well, what are all the possible ideas? What are all the possible options? We just throw things out there. And then we have to start weeding them out. So once we have all the ideas on the table, then we start weeding them or simplifying them down, getting rid of the ones that are totally not possible, not feasible, or don't fit in with the scope or the mission of our organization. And we narrow that down till we're left with the project or projects that do make sense for us, that are feasible, that are within our scope, and will help to take advantage of an opportunity or to solve an existing problem within our organization. The focus of much of what we will do in this chapter is looking at three different methods for analyzing or for evaluating capital investment proposals. So, God bless you. So actually, I guess I should say 4, because internal rate of return is kind of its own. It's based on one of these 4. But if you look at learning objectives 2 and 3, there are 3 really separate approaches. And then internal rate of return is kind of a spin-off on net present value. So it's 3.5 maybe different ways of evaluating capital investment proposals. And we'll be talking about the advantages and disadvantages of each one. I will tell you which one companies are more likely to use because of the advantages it has. And yeah, that's pretty much going to be the chapter. So how do companies decide where they're going to spend their big money? So we just a couple of weeks ago did a chapter on budgeting. And at that time, I told you that capital budgeting, although it is related to our operational budgeting, is somewhat of a different and parallel process. So the decision making that goes into capital budgeting, although it is impacted by and can impact operational budgets, it is somewhat of a different animal. And so I told you in that budgeting chapter that we would spend more time in this chapter talking about what it means to have a capital budget and how those decisions are made and why they're different, why the focus is different than for operational budgeting. So capital investment analysis, capital budgeting. By capital, we mean long-term investments. When we say that we are going to capitalize something, for example, it means rather than writing it off or recording it as an expense right away, we put it on the balance sheet. Again, we capitalize it. We put it on the balance sheet and we then write it off as depreciation over some period of time. So capital investment, the dollars that we're talking about for capital investment can be quite substantial. And there's usually a limit. I mean, every company has a limit on how much they have available for capital investment purposes. So how are they going to expand and grow? What assets do they have that need to be replaced or updated, upgraded? And so I can use JCC as an example of how this process works. And I want to put that slide up yet. So every year JCC puts out kind of a call to the employees to say, what do you need? What do you need to run your program? What do you need to run your department? Kind of like a wish list of, here's where we'd like the college to invest or spend some money. It's a little bit different for JCC as a not-for-profit than it would be for a for-profit, a manufacturing company, but the concepts are still the same. If I wanted to put forward a proposal, let's say for a new computer lab in the Hultquist building where most of the business classes are housed, and right now there is not a classroom that is a computer lab like where we are sitting right now. If I wanted to put forward a proposal for that, I would have to gather all of the information about, well, how much is this going to cost in terms of the computers or any other hardware that's needed, how much time is going to be involved for the IT people to get a room ready, what are the ongoing operational costs going to be on top, just like we talked about in the last chapter, that marginal or differential, what costs are going to change. And not only are we looking at the additional expenses, but also, where appropriate, the additional revenues that might come from that. So if we had a lab that was state of the art and maybe we were able to start running some, I have no idea, some computer related courses that we don't currently offer on campus, just throwing that out there, then I could include in that projection, here's the additional, the marginal revenues that could result from that computer lab. Here are the additional expenses that would result from that as well. A for-profit business has the same type of process going on. So they're asking, what do you need? And their employees are throwing proposals on the table. Here's what I need. Here's what it would cost. I've gotten some different quotes. Here's what it would cost. Here's the benefit to the organization. And ultimately it's going to come down to, is it worth it? Can we afford it? So let's just say our company has, I don't know, 10 different proposals that are thrown on the table. most companies, and again, when we're talking about a for-profit, it's a little bit easier maybe to do that, or to think about how that analysis would work. Most companies then are going to have some kind of what's known as a hurdle rate. And if you have ever watched track and field, you know what a hurdle is. A hurdle is something you have to get over, jump across, jump over to get to the next, to keep going in the event. A hurdle rate in business for capital investment purposes is the same concept. It's the minimum expected or required rate of return. I probably should have said required there. It's the minimum required rate of return. And so as we are looking at, as we're vetting all of these capital investment proposals that we have, we're going to look at each one of them and take a look directly to the bottom line and say, is this even worth it for us? Now, I know I talked about in an earlier chapter the idea of the capital structure of the company. And what we mean by that is the makeup of the long-term liabilities, the contributed capital, and the retained earnings. So where does all the funding come from to do this stuff, to run our business? How much do we need? And I referred to it, I'll put this term back up on the screen as well. I referred to it in that chapter as the WACC, or the weighted average cost of capital. And the idea, there we go. The idea of the weighted average cost of capital is this is the minimum that we need just to fund our borrowing and our investment piece. So it would make sense for a company, if they're saying these are proposals we would consider, and anything less than this we would not consider, it would make sense then for that hurdle rate to be in some way related to the weighted average cost of capital, right? We're not going to take on a project that's going to make us lose money, that we can't even afford to fund it. And so as we do kind of a preliminary sift through these proposals we have, we're immediately going to throw out any proposal that doesn't hit that hurdle rate. It's a non-starter. It doesn't even get out of the gate because we can't afford this. We're not going to take on a project that's going to make us lose money. And so once we've done that preliminary sift through, we're left with only proposals that we know are going to meet that minimum hurdle rate. And at that point, it becomes a ranking or an ordering process of which of these is most critical to the mission of the organization, which one has, and at the same time has the highest kind of returns that we're looking for. We know at that point that every proposal or every project at least meets the minimum, but we still, the chances of us being able to fund every one of those projects is close to zero, even though in our textbook world, sometimes we might find that we have all the money we need. We know that in reality, even for large companies, even for very successful and profitable companies, they do not have an unlimited pool of money to invest in the growth of the organization. Everybody good so far? And so as we look at our capital investment opportunities, all of the proposals that we have left, we have already sorted through them to say these are the ones that we're not even going to consider because they don't fit in with the direction the company's going, or they don't meet our minimum required rate of return. And here are the ones that we're still going to consider, but now we have to do some kind of a ranking or ordering of these to determine what we can fund and what's going to have to wait or be rejected. As I already told you, we're going to be looking at what I'm calling 3.5 different methods for evaluating these capital investment opportunities. And the first two we're going to look at are the ones in green on the left of this flow chart. And these are methods that do not use present value. So in the last chapter, and the few minutes ago, I was expressing to you the importance of keeping in mind that time value of money, which is present value. That's the same concept. So why are we introducing two methods that violate what I already said? Hey, it's important that we look at this, and now I'm telling you, but two of these methods don't. Well, there's a couple different reasons that we might decide to use either one of those two methods in green. The average rate of return method, which is also known as the accounting rate of return method, is appealing because it uses accounting information that people are already accustomed to using. People see those data all the time, and so it's maybe a little bit more comfortable for people who aren't accustomed to more financial results. They're looking at accounting information. And so that's a rationale for using the average or the accounting rate of return method. The other one, the cash payback period method, the reason that may be used or sometimes used, even though it doesn't use present value or time value of money concepts, is because the time frame for the cash payback method is normally very short. So we'd only be looking at the first few years of a project. And so, as we said last week, when we're looking at shorter time horizons, the time value of money isn't as relevant, isn't as meaningful. But most companies, because of the limitations of those first two methods, because they don't use present value concepts in their calculations, most companies are then going to use one of the methods on the right-hand side, the methods that do use present value. They're just a little bit more complicated in terms of how the calculation is done. You can't necessarily do it on the fly. It takes either a special calculator or a spreadsheet or special charts that we'll be using. So it's not something you can just calculate in your head as you're kind of throwing numbers around. But we're going to start with the average rate of return method. Let me get ahead here. So we're going to start with the average rate of return method, or what I told you is also sometimes called the accounting rate of return, because it uses information that's readily available from the company's existing financial statements, or it expresses information in the same way that people are used to seeing it on their financial statements. So you may want to make a note of the calculations there on the screen for average rate of return. We start with the average investment. The formula is at the bottom of the screen. So the average value of the investment is, we're doing a straight line average. We start with the upfront cost, and we not speculate, that's a terrible word, and we estimate how much that investment's going to be worth when we're done using it. Concept from chapter 9, and that is residual value, also known as salvage value, scrap value, trade-in value. The residual value is how much is this investment, maybe it's a piece of equipment or a building or whatever, how much is this going to be worth at the end of this project? And so the average value of that investment over time would be the upfront cost plus the residual value divided by 2. That then feeds into, or becomes the denominator in the average rate of return calculation. Then the numerator you can see is average annual income, and that would be the income that you would see on your income statement. And so it includes all of the costs and expenses, including the non-cash costs like depreciation. So for the average rate of return method, a company must decide in advance, here's what's acceptable. Kind of that hurdle rate that I already mentioned. Here's what's acceptable. We require that the average rate of return exceed, throw a number out, 5%, 20%, whatever it is. 20% would be super high. So these are the formulas that we're going to use, and we are going to go to our first exercise to see how to use average rate of return. Yeah. The following data are accumulated by Watershed Incorporated in evaluating two competing capital investment proposals. So these two proposals have already been vetted. We have already determined that they are within the scope of our organization, that they will support the mission of our organization, that this is a direction we might consider going. So either one of these projects would be acceptable. It says they're competing capital investment proposals. So one of two things is probably true. Either if we do A, we can't do Z, that is, they are maybe they're two pieces of equipment that do the same thing, or we don't have the funding to do both of these. So for some reason, the company is not trying to decide whether to do both or just one. These are competing, and we have to decide which one. The way I've described the process, the assumption is either one of these projects already meets that minimum required rate of return or hurdle rate, but we don't know that for sure with the information we are given here. But let's go ahead and work on the average rate of return for project A. So the first thing we want to do is find the average value of the investment over its life. So the upfront cost for that investment is $55,000. And we believe, based on our research, based on the information contained in the proposal, that at the end of its life, it's still going to be worth $5,000. In other words, we can sell it for $5,000 once the project ends. And so $60,000 divided by 2, at any given point, or throughout the life of the project is probably a better way to say it. Throughout the life of the project, the average value of the investment on our balance sheet is $30,000. Starts out worth 55, ends up worth 5 at the end of the 12 years. Straight line depreciation, it's going from 55 down to 5, and halfway through the life, it's worth 30. So that's your average investment cost. The estimated total income over the useful life of the asset is $57,600. That's over the life of the asset. And this is a 12-year project, a 12-year commitment, if you will. And so how much are we making per year? $57,600 divided by 12. The average annual income is $4,800. They already said that includes the depreciation on the project and all of the costs and revenues associated with this project, whether they are cash or not. And so now we can do our average or accounting rate of return calculation. The average annual income divided by the average value of the investment. And so project A returns 16%. That would be their average. In financial analysis terms, we would call that their profit margin, the average profit margin on this project. Everybody okay with that calculation? Okay, try Project Z on your own. Put mine on the screen. And so Project Z is a little bit cheaper. It has a longer expected useful life, and it has a higher residual value. The total income over the life of the project is a little bit higher. However, because it's more years for Project Z, the average annual income is actually lower. And so the lower annual income is not, doesn't overcome the lower upfront cost and the higher residual value. And so the expected average rate of return for Project Z is only 15%. So as I already suggested, the company should have a minimum number that, and I don't know what that number is, it's up to the company. It's based on, in part at least, their weighted average cost of capital that we've already discussed. And so, you know, I can't look at these and say 15 and 16 are acceptable, but I assume that that step has already occurred. That if they've gotten to this point in the process, they already know that either one of these projects would be acceptable, and the fact that it says they're competing means we're trying to decide which one would be better. And so based on this, what would you tell the company? Which project should they undertake? Assuming that both of these are acceptable. Which one is better?
16%.
Yeah, so definitely a higher number is better. We're looking for a higher rate of return. Again, it's really equivalent to the profit margin associated with this project. And so 16 is definitely better than 15. But I already explained some of the limitations, and we'll go back to the PowerPoint and look at those as well. Some of the limitations of the average rate of return. So let me just pull that up here. And so advantages, it's obviously really easy to compute, right? Simple calculations, not a lot to it. Now, someone had to come up with those numbers that were the cost of the project and the residual value and the average or the expected income over the life of the project. So it's that part's the harder part than what we had to do here, but it is easier to compute than the time value of money based approaches, for sure. It does include all of the income over the life of the proposal. It did take into account the residual value. It did take into account the annual cash flows for the entire life of the project. And so those are advantages compared to what we're going to look at next. I also mentioned it emphasizes accounting income. It uses a concept that people are already accustomed to seeing. They understand what's on the income statement. And so to give them information in that format is very appealing because people are accustomed to seeing that already. They know what that means. Disadvantages. It doesn't look at cash flows. It looks at accounting income, which includes non-cash expenses such as depreciation. And it does not look at the timing of those cash flows. So when we calculated the annual income, that was an average over the lifetime of that project. It could be that the project is really slow to start. And maybe there are losses in the first 5 years, and then we start to generate more income in the later years of the project. But when we're not taking into account the time value of money, it's a bit problematic to treat $1 today, again, $1 15 years from now, as if they're equivalent, because they're not. And so that creates a bit of a disadvantage for this approach. If, as we have in that first exercise, if we have already decided that either one of these projects would be acceptable, it's not totally off base to use this approach. There's a reason we're covering it, but it's not ideal, let's say. So the final disadvantage that we see on this slide is it doesn't consider cash flows, and it doesn't consider the timing of those cash flows. So in our next exercise, in exercise 2, we're going to look at determining cash flows. So looking at cash flows rather than accounting income, which includes non-cash expenses such as depreciation. So for our next method, the cash payback method, we need to be able to convert from what we're accustomed to seeing, which is accounting income, to cash flow. So we're not looking at all of the costs and expenses that might appear on our financial statements. And so our next exercise is calculating cash flows, and then we'll come back to this cash payback period. But I'm not going to come back to the PowerPoint right away. So if you are in the habit of writing down your formulas, you may want to make a note of this formula. It is important for this formula that annual net cash inflows must be equal to use this formula, and we'll talk about what if they're not. But you may want to take a note of that formula. Cash payback period is the upfront cost divided by the annual net cash inflow, as long as they're equal each year of the project. Put my green check marks in there, and then we'll go ahead to our next exercise, which is determining cash flows. Natural Foods Incorporated is planning to invest in new manufacturing equipment to make a new garden tool. The new garden tool is expected to generate annual additional sales of 5,000 units at $18 each. So again, keep in mind that concept of incremental or differential or marginal analysis that we spent all last week talking about. It is expected to increase our annual sales. So we're not looking at all of the sales. We're only looking at the sales that would be additional based on this investment. The new manufacturing equipment will cost $120,000 and is expected to have a 10-year life and a $17,000 residual value. Selling expenses related to the new product are expected to be 3% of sales revenue. The cost to manufacture the product includes the following on a per unit basis. We have direct labor, direct materials, fixed factory overhead, which is depreciation, and then our variable factory overhead. The total cost per unit then in our accounting terms is $9 per unit. We're asked to determine the net cash flows for the first year of the project, years 2 through 9, and then for the last year of the project. We're asked to use a negative sign to indicate cash outflows. Don't round intermediate calculations, but if needed, round your final answers to the nearest dollar. So in year one, we have to buy the equipment. The equipment's going to cost $120,000. Since it is a cash outflow, we're going to show that as a negative. Now, we're not looking at the total revenues for the company. We're only looking at the incremental or differential analysis. So for the annual revenues, we are looking at annual additional sales of 5,000 units at $18 each. And we're going to show that as a positive because it is a cash inflow. Selling expenses are expected to be 3% of sales revenue. So if our sales are 90,000, 3% of that would be 2,700, and then it would be a cash outflow. So we're going to show that as a negative. Now we're given these costs to manufacture the product, but there is a cost on here that is not a cash expense, and that would be this, the depreciation. And so rather than using $9 per unit, we're going to use $6.60 per unit. So $9 minus the $2.40 of a non-cash expense is $6.60 of cash expenses for each of those 5,000 units. And again, that is a cash outflow. So we are going to show that as a negative. As long as you have your negatives and positives in the right place, we can simply add and subtract or combine this column. The net operating cash flows does not include the initial investment. This is the operating cash flows. Capital investment is not operating. And so if we net together the revenues and the expenses that are given there, we end up with a positive net operating cash flow, but then we have to subtract from that the upfront cost. And so in year one, we are anticipating a cash outflow of $65,700. Whoops. Make that a little bigger. $65,700 in net cash outflow in year one. Years 2 through 9. So that's a total of 8 years, but this isn't clear in the way the exercise is written. They want 1 year worth of results in this column, the years 2 through 9. Each year is going to look the same, which is $90,000 in revenues, $2,700 in selling expenses, and $33,000 in variable costs to manufacture. Each year is expected to bring in $54,300. I think this is very misleading because to me, it says total for years 2 through 9. And I think, ooh, I take the 54,000 and we want all 8 years. So we're going to multiply by 8. That is not what the template is expecting. It only wants the 1 year operating cash flow. So if we were doing a summary of this, we would need to keep in mind that that's $54,000 each year for the 8 middle years, 2 through 9. And then finally in year 10, everything again looks the same. Whoops. But the project is over and we can now sell the equipment. And we are told that the expected residual value, somewhere up here, expected to have a $17,000 residual value. So at the end of year 10, we would sell it and increase our cash flows by 17,000. Whoops. So I don't particularly care for the way this is presented, because I think that label could be a little more clear. But the total operating cash flows in year 1, they're negative. In year 2 through 10, they are positive. If we did not take into account the time value of money, this would look like a pretty good project to undertake, right? Because we more than make up for the upfront cost. But again, there are limitations to even just looking at these data, because none of this takes into account the time value of money. The calculation of cash flows like this is going to be helpful for us in our next exercise, which is the cash payback method. It would also be helpful for us in the net present value approach that we're going to cover after that. So the purpose of this exercise is simply to point out that cash flows and accounting income can be very different. We just disregarded this $2.40 in depreciation. Why did we disregard that? Because it is based on the purchase of the equipment, and we're taking into account the entire cost of that equipment in year 1, because that's when the cash flow happens. Any questions about calculating cash flows? So we've seen depreciation here. Just a reminder, we have 2 other forms of non-cash expenses, and they are depletion of natural resources and amortization of intangible assets. And so you could also need to include those or discount those from your cash flow calculation. Depletion and amortization. So let's move on to exercise 3. And in this exercise, we are going to be using cash flows. Lilly Products Company is considering an investment in one of 2 new product lines. The investment required for either product line is $540,000. The net cash flows associated with each product are as follows, and you can see there, each one of these projects is expected to cost $540,000 up front and return $720,000 over the 8-year life of the project. So if we ignore the time value of money, we would say either one of these is a winner, right? Because the cash flows that come in are much higher than the cash that would go out up front. But we shouldn't be ignoring the time value of money. This exercise, though, is giving us a different way of looking at this. And this, as I said, is the cash payback method. I showed you the formula before I switched over from the PowerPoint. And so that formula, remember, required can't just highlight the body lotion column, requires that the that the annual cash flow be equal to use that formula that I showed you. So we have, we can use that formula for the body lotion investment. And this is what the formula told us to do. So to find the payback period, whoops. To find the payback period, if we have equal annual cash flows, we take the upfront investment and we divide by the annual cash flow. And so we can use that calculation for column B for the body lotion, for the second column, for the body lotion column. The upfront cost is $540,000. And the annual cash flow is $90,000. So in other words, if we bring in $90,000 a year, how many years is it going to take for us to get our money back? If this project costs $540,000 upfront and we bring in $90,000 a year, it would take us 6 years to get our money back. As I indicated, the company should in advance have a number in mind, which again, you can think of it as the hurdle rate if you want to. That number is the maximum amount of time that they're willing to wait in this context, the maximum amount of time they're willing to wait to get their money back. It would take them 6 years to recoup their initial investment. And they should know already, is that acceptable or not? The longer we have to wait, the more critical it is that the cash payback method does not take into account the time value of money. And in general, 6 years is not going to be an acceptable period of time. This exercise does not tell us what their expectation is. But we do have a six year payback period for the body lotion, and we'll come back to that. For the liquid soap, it's not as straightforward. We don't have the same type of calculation for that because of the irregular cash flows associated with the liquid soap. And so this is what we would do. The upfront cost is $540,000. In year one, the project returns $170,000. And so the unrecouped investment at the end of year one is $370,000. In year two, brings in $150,000. So the unrecouped investment at that point, whoops, I should put a parentheses there. And so this is just an iterative process of repeating of the same steps until we get to the point that we have completely recouped our investment. And so how long did it take us with those irregular cash flows? How long did it take us to get our money back? 4 years. Well, what if we didn't have this textbook world where we exactly magically at the end of year 4 had recouped all of our investment? We might need to to find a portion of the year. So let's just say, just for the sake of argument, that in year 4, our projected cash flows were 200,000. We only needed 100,000 more to get our money back, so it would take half the year, half of that 200,000. And so the answer then would have been 3.5 years. As they frequently do, they made these numbers nice and convenient for us. We have a 4-year payback period for the liquid soap. Again, both investments both projects would cost the same upfront. Both projects return the same amount of cash flows over the same 8-year period, but liquid soap is front-loaded. We do get our money back more quickly. And so the project with the greatest net cash flows in the early years of the life of the project will be favored over the one with the smaller net cash flows in the early years. And that actually is consistent with the concept of the time value of money, that we're rewarding earlier cash flows and kind of punishing, if you will, the cash flows that happen later on. But in reality, for the payback period method, we didn't even need to know what the cash flows were for body lotion in 7 and 8. They could have been 0, and our answer would have been the same. For liquid soap, any cash flow that happened after year 4, we didn't even take that into account. Again, it could have been 0. So recommended product offering to Lilly Products Company based on the cash payback period. And we would say we would prefer the liquid soap. I'm suggesting that even 4 years might be too long for the cash payback period method. But the exercise does not tell us what the company had determined was an acceptable payback period. Okay, questions about that before we go look at the advantages and disadvantages? Oops. Okay. So when we're using the cash payback period method, we're looking to get our money back sooner rather than later. Less chance of risk coming in, changing economic or business conditions, getting our money back earlier. This doesn't specifically say it, but is consistent with our understanding of the time value of money. And so that's a very important factor as well. As I suggested, most companies are not going to be comfortable, be on board with a cash payback period method result that is 6 years, as we saw for the body lotion in that exercise. So you can see how intuitive both of those approaches are, how they seem easy and straightforward, how it just kind of makes sense with what we already know about accounting. And but as I said, the problem is that they don't, they don't take into account the time value of money. And as I just showed you for the cash payback period, it didn't even take into account all of the cash flows associated with the project. Nowhere in there were we even told anything about whether the machines have a residual value or not. We don't know. And it's not relevant for that approach to the calculation, but that's what makes it somewhat problematic, because we didn't even take into account all of the cash flows, only the ones in the years until we get our money back. And then it's kind of like, we don't care what happens after that. And clearly we do. Okay. moving on then to the concept of the time value of money. So I've really already given you a bit of a heads up about what that means. I've given you, kind of a very basic analogy. If I give you $1 today or $1 next year, which one would you prefer? And it's clear to see that you'd rather have it today. If you're given the option of spending $1 today or next year, you'd rather wait till next year. That is the concept of the time value of money. And so in particular for you guys who are here, since none of you had me for financial accounting, and some of you didn't even take financial accounting at JCC. So those of you who are here at JCC, you should have seen that if you got to chapter 11 in financial accounting. But I can't guarantee that happened because you were not in my class. And even if you did cover it, it wasn't yesterday. And so we're going to start out with a bit of a review about how to do the time value of money calculations to begin with. And what we're going to be using to do those calculations are tables. Like the tables are in your textbook, but our exercises also give us the tables embedded right in the exercise, or I think in the problem, make that a little smaller. In the problem, there might be a green link that pops the table up in a separate window. But I think that's how it is on the exam as well. So you should be familiar when we finish this section, you should be familiar with how to use the tables. And for this class, for any purpose where you might need the tables, it will either be provided to you just like this, or there will be a hot link in right in the exercise or the problem that says like exhibit 5 or exhibit 7, and you click on that and it brings up the table for you. Okay. The following data are accumulated by Getty's company in evaluating the purchase of $150,000 of equipment having a 4-year useful life. And so we have our net income, we have the net cash flows. You can see that the net cash flows are greater than the net income because we've excluded from that calculation the any non-cash expenses such as the depreciation. So depreciation is irrelevant to our decision making because we don't get to put off paying for this equipment. The $150,000 cash flow to buy the equipment would be initial. It would be at the very beginning of the project. And then these are the cash flows that would come in projected for each of the 4 years of the project. It doesn't tell us anything about whether that equipment has a residual value to it, at least not at this point. So in order to use the NPV or net present value method, the NPV analysis requires information about what is the acceptable rate of return, or what is the discount rate that we are requiring, that we are building into this calculation. So we cannot do a net present value calculation without knowing here's the minimum expectation that the company has. And as I've already indicated earlier in class today, that number is likely to be related to that weighted average cost of capital, that they need to cover their cost and then have some reasonable expectation of a profit, hopefully on top of that. And so letter A tells us, assuming that the desired rate of return is 15%. So that 15% is what the company requires at a minimum. To consider a project, it must return at least 15%. So we're asked to determine the net present value of this proposal. Okay, if required, round to the nearest dollar. Use the table of the present value of $1 presented above. And so what we're going to do is take all of those future cash flows associated with the project and compare it with the upfront cost. The amount to be invested was $150,000. And what we want to determine is, will this project bring in more than $150,000 when we take into account the time value of money? So just by way of review, let me point out to you, if we were using the cash payback period method, what would be the payback period for this project? Well, we'd bring in 80,000 in year one, so that would leave 70,000 still out of the 150. Year two would bring in 65,000. We'd need only $5,000 in year three. So it would be 2 years plus 1/10. So a month, just over a month into year three would be the cash payback period method. But again, that disregards the time value of money. And so we need to take that into account. And I need my tool here. So we are told that 15% is the minimum expected rate of return. And this is a 4-year project. So I'm just putting a box around the relevant information from the table. You'll notice it's critical that we have the correct percentage, the discount rate at the top of the table. And down the left-hand column is the number of years or the number of compounding periods. So those factors that I just boxed out here in the table are what we're going to use to do the calculations to discount those future cash flows back to present value. The formula that we're going to use then is the present value, which can be abbreviated as PV, is the future value or future cash flow times the factor, present value interest factor, PVIF, from the table. So a factor, you should recognize that word from math class. A factor is something that you use in a math expression, something you're going to multiply by, right? So if I said, what are the factors of 15? You should know that that's 5 and 3. 5 times 3, you multiply 5 and 3 together to get 15. What's in this table are factors that we're going to use to multiply by the cash flow to bring it back or discount it to present value. You'll notice that all of the factors in the table are less than 1. And what that tells us is the present value is always going to be less than the future value. So year one, the cash flow is $80,000. And we want to multiply that by the factor from the table. Actually, I don't need to put that over here. Let me move this over here so I don't be efficient. So we take the future cash flow of $80,000 at the end of year one. And from the table, we want the factor that corresponds with 1 year and 15% as the required rate of return or the discount rate. So the factor from the table, 15%, 1 year is 0.87, right? $80,000 discounted at using that 0.87 factor. The present value of that future cash flow, $69,600. If you look at that table, you'll notice the higher the discount rate, the more those future cash flows are going to be discounted, the less they're going to be worth to us today. So the higher the discount rate, the less the present value will be. And if you go down the table, the longer you have to wait for a future cash flow, the less it's worth to us today. And we get that, right? So we can do those same calculations now Because this is not a regular cash flow, we have to discount each of those cash flows separately. Luckily, we only have 4. So the $65,000 at the end of year 2 would be worth $49,140 to us today. The $50,000 at the end of year 3 worth just $32,900 to us today. And when we have to wait 4 years for that final cash flow from this project. Whoops, that shouldn't be an equal sign in. Oh yeah, yes it is. Sorry. Never mind. It is an equal sign. So I did say that this doesn't show a residual value at the end of year 4. It could be, I don't know, but it could be that there is a residual value and it's included in this $40,000. Definitely, if there is any residual value, it should be included in, at the end of the project. I was thinking it wasn't included because that 40,000 is lower than all the other years. It didn't seem like that was probably included, but it's possible it's in there. And so now I just need to add up the net present value, or NPV, of all of those future cash flows. $174,520. The total cash flows, if we were to ignore the time value of money, the total cash flows are $235,000. But when we take into account the time value of money, what's that? When we discount all those future cash flows back to present value, the present value of those cash inflows, $174,520. And so the upfront cost of $150 is covered, and we have $24,520 as the positive net present value, or NPV, of that proposal. And so how do we evaluate that? Well, keep in mind, we've already discounted all those future cash flows at the desired rate of return of 15%. And so if our NPV is positive, if it's even $1, that means that's $1 more than the required 15% rate of return. If the NPV is 0, we would still consider that project because it's returning exactly the 15% that we said we require. Yes, sir.
So the 22,000, or I'm sorry, 24,000, that's $24,000 more than the 15%.
Yes.
Oh,
yeah.
I thought that was on the 24,000. It's like 15%, like what we needed.
Nope. The 15% is built into these calculations of the present value. So an NPV of 0, we would still consider. So would management be likely to look with favor on this proposal? The answer is yes, because the NPV indicates that the return on the proposal is greater than the minimum desired rate of return of 15%. As I said, an NPV of 0 means it returns exactly 15%. And so that's not unacceptable. That's just the minimum we would want. And so thinking about the NPV approach, all of the criticisms that we had of those other approaches, that they didn't include all of the cash flows. Well, the NPV method does require that you look at every year of cash flows. This project only has a 4-year useful life. And as I said, if there is a residual value to the equipment, it would need to be included in this net cash flow in year 4. It includes all of the cash flows. It does take into account the time value of money. It does take into account the timing of those cash flows as well. So a dollar in year 4 is discounted more than a dollar in year 1. They're not treated the same as they are in the other approaches. Okay. And so I said in that previous exercise that one of the, I guess, concerns, or one of the problems, one of the reasons that that exercise was a little bit more tedious, that we had to do 4 separate calculations, is because it wasn't a regular cash flow. But thinking back to the exercise we did at, I think it was exercise 3, where that body lotion returned $90,000 a year every year for 12 years or whatever it was, 8 years, whatever it was. Sometimes that is our assumption, that there are regular cash flows. Imagine if a project is a, what's this one? 5 years. Okay, so this project is that we're looking at in our next exercise, which will be our last exercise for today. This project is expected to last 5 years. Well, it's not uncommon for projects in business to last, 10 years or 15 years or more. So imagine if we had to do a separate calculation and look up a separate factor for each year for 20 years. Just gets a little tedious. In this exercise, we're going to see how to do those calculations if we have a regular cash flow, if the cash flow is projected or predicted to be the same every year. That is our concept of an annuity. The root of the word annuity means year, right? It's like annual, you know what that means, right? Something that happens every year is an annual event. The concept of an annuity is a regular cash flow that happens at the end of each period for a given number of periods, same amount every year for a given number of years. And I'm mostly avoiding using the word year, and instead I've been using the word period, because sometimes our compounding period is less than 1 year or more than 1 year. It could be, think about if you have a bank account that's earning interest, that interest is compounding monthly. If you have a loan that you're paying a monthly payment, the interest is compounding monthly. And so the factor should be based on that once a month, not once a year. This table actually says year, but this table could just as easily be used if the compounding period was 1 month, as long as the interest rates were monthly, not yearly interest rates. Jones Excavation Company is planning an investment of $125,000 for a bulldozer. The bulldozer is expected to operate for 1,000 hours per year for 5 years. Customers will be charged $90 per hour for bulldozer work. The bulldozer operator costs $30 per hour in wages and benefits. The bulldozer is expected to require annual maintenance costing $7,500, and it uses fuel that is expected to cost $15 per hour of bulldozer operation. So the first thing we need to do is determine the annual net cash flows from operating the bulldozer. So we know the cash inflows are based on the number of hours that we're operating and how much we're charging. 1,000 hours a year, this is the annual amount. So 1,000 hours a year, we're charging $90 per hour. our revenues for the year associated with the use of this bulldozer, $90,000. We have to compare that to then the cash outflows for the year. So we have maintenance costs for the year, which were 7,500 if memory serves me. Oh, that. Okay. I think we're gonna have to move that one, but let's see what else we have here. So we have maintenance, we have our fuel costs, and we have our operator wages. So those are the three pieces that we need to cover. So let's see where they're going to fit in. There's not a wrong order to put these, but there is an order that the template expects from us. So let's see if this one is fuel cost per hour times the number of hours. Oh, and the labor cost per hour. We can add those together. Okay. Yep, and I'm going to have to change this to the hours of operation, which means that the maintenance costs are going to go down here. Again, there's not a wrong order to put those, but it's just the order that they're expecting them to be. So hours of operation, 1,000, and fuel and labor together cost $45. So that would be a $45,000 cost plus the maintenance cost. Okay. So $90,000 of revenue minus $45,000 to cover fuel and labor, and $7,500 in maintenance. We have $37,500 by my calculation of annual net cash flows.
So for the next part, to get the 10%, we're just using the chart. So rather than 15% like last time, we just use 10% for 5 years.
I haven't even read that yet, so hang on a second. Okay, so the first thing we needed to know was the annual net cash flow. So everyone's okay with where that came from? Okay. Determine the NPV of the investment, assuming that the desired rate of return is 10%. So yes, we're using the 10%.
Okay.
This is an annual cash flow. So we could use a table like we did in the last exercise and do a calculation for year one at 37,500 times some factor, year 2, year 3, year 4, and 5. That's 5 years, right? Yeah. We could do 5 separate calculations, one for each of the 5 years, and then add them together, just like we did with the 4 in the previous exercise. However, this table is for an annuity. There's something about this table that looks different than what we saw in the previous exercise. Remember, I pointed out to you in the previous exercise that all of the numbers were less than 1. Remember, I pointed that out. What about this table? The only ones that are less than 1 are year 1. We can tell that there's something different about this table. This table is meant to discount an annuity, a series of cash flows where as long as the cash flow is the same every year, we only have to do one calculation. And that calculation is going to be based on the 10%, and this is 5 years. And so we only need one factor, one calculation, as long as the cash flow is the same every year. And the factor for 10% discount rate, 5 years for an annuity, 3.791, the intersection of those two lines, 3.791. Everybody see that?
Mhm.
And so now, excuse me, present value of those cash flows we calculated was 37. Whoops. Sorry. Doesn't give me room there to calculate that. Let me put the calculation here on the screen. 37,500 times that factor from the table. 3.791, I hope it was. What it said. And we need to round that off to the nearest dollar. 5 rounds up. So the present value of those annual net cash flows, 142,163. How much are we really bringing in if we ignore the time value of money? 37,500 times 5. The total cash flows over the 5 years of the project would be $187,500. 5 years at 37,500. However, we have to wait a year, 2, 3, 4, 5 for those cash flows. And so it's not worth that to us today. Instead, it's worth 142,163 using that 10% required rate of return. The investment itself, the cost of the bulldozer is $125,000. And so we end up with a positive NPV of 17,163. Should Jones invest in the bulldozer based on this analysis? What's our answer?
Yeah.
Yes. Because the bulldozer cost is less than the present value of the cash flows at the minimum desired rate of return of 10%. Determine the number of operating hours such that the present value of cash flows equals the amount to be invested. Round interim calculations and final answer to the nearest whole number. Okay. So, excuse me. We know that the factor, there's a couple different ways you could go about doing this. I'm going to try to do it the simplest way, the efficient way. So, but my concern is that rounding then might throw us off a little bit. So if the factor is 3.791 and so the present value is the future value times same formula I already gave you. Future value times 3.791. That's the factor from the table based on the 10% in the 5 years. And the present value is 125,000, right? That's the cost of the bulldozer. So the future value $32,970 if we round off $3. So the annual net cash flow would need to be 32,000, rounding off $32,973 for us to break even, for the future value to be exactly equal to the present value of 125. Okay, so the annual cash flow would need to be 32,973. Everyone okay with where that came from? And did the same calculation I did here, but rather than knowing that the cash flow was 37,500, I said, well, what would it have to be to match that 125 upfront investment? In order for us to be willing to accept this proposal, it would need to be 32,973 rather than 37,500. So the first, does anyone want to ask a question about that? You okay with where that came from? It's the same formula that we just used, but I had a different unknown. So we know that there's a $7,500 maintenance that we can't avoid. That's a flat fee. And so that leaves us with 25,472 that we would need to cover still. And I'm running out of time. I mean, I'm afraid I'm going to get this, that the rounding is going to throw me off here. And I'm trying to hurry because of the time. So I think in the interest of time, I just want to stop here, and I'm going to pick up on Thursday with this last part of exercise 5. And then I'll be able to make sure that my rounding isn't going to throw us off. Because unfortunately, if we don't do it exactly the way the book wants, then the rounding is going to make it say we're wrong. So we'll pick up there on Thursday with just part D. You'll have your work saved from the beginning part, and we'll try that again. All right, thanks for being here, and I'll see you Thursday.